Good evening, everyone. John McNichol here, and welcome to Income Investing, generating income with dividend stocks for April 2nd, 2018. Hope everyone's doing well, those of you that are here live, as well as listening to the archive session. Let's go ahead and take care of our disclosures. Make sure you carefully consider the investment objectives, risk charges, and expenses before investing. Prospectus can be obtained by calling that toll-free number provided. Contains this and other important information about an investment company. Read carefully before investing. ETFs can entail similar risks of direct stock ownership. As you can see, some of the risks listed here, such as market sector and industry risks. Trade prices may not reflect the net asset value of the underlying securities, and commission fees typically apply. There's no guarantee a closed-end fund will achieve its investment objectives. Past performance does not guarantee future results. As you can see, some of the other disclosures here. Closed-ended funds may trade at a premium or discount to their net asset value. As well as international investments involve special risks, including currency fluctuations and political and economic instability. Asset allocation and diversification do not eliminate the risk of experiencing investment losses. As you can see, the risks associated with some other products, such as fixed income, are subject to liquidity risk, interest rate risk. Keep in mind that bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Also, financial risk, inflation risk, and special tax liabilities may be worth less than the original cost upon redemption. Investment in REITs and other real estate securities are subject to the same risks as direct investments in real estate, including loss of principal. The real estate industry is particularly sensitive to economic downturns. Be sure to consider your own financial situation, perform your thorough research, and consult with a qualified tax professional before making any investment decisions concerning REITs. As well as investments in commodities not suitable for all investors, as they can be extremely volatile and can significantly be affected by world events, import controls, world competition, government regulations, and economic conditions. All certainly have been coming into play recently in the markets. Options are not suitable for all investors, as special risks inherent to options trading may expose investors to potentially rapid and substantial losses. Carefully read previously provided copy of characteristics and risks of standardized options. Spread straddles and other multi-leg option strategies can entail substantial costs on a transaction, multiple commissions, and may impact any potential return. Also, advanced option strategies involve greater and more complex risk than single-leg options. Investors should also consider contacting a tax advisor regarding the tax treatment applicable to spreads and other multi-leg option transactions. As you can see, some of those transaction costs that are outlined on the disclosure here. Now, in order to demonstrate the functionality of the platform, we need to use actual symbols. However, TD Ameritrade does not make recommendations or determine the suitability of any security or strategy for individual traders. Any investment decision you make in your self-directed account is solely your responsibility. Past performance of any security or strategy does not guarantee future results or success. As you can also see, probability analysis and backtesting are dealing with theoretical or back information there. No guarantee that that same strategy implemented today would produce similar results in the future. And as always, folks, all investing involves risks, including the risk of loss. Good evening to you as well, Robert, on the chat there, as well as everyone else here. Certainly don't be shy. You can send your greetings through on the chat, as well as if there are any relevant questions pertaining to our topic this evening. And let's go ahead and get right into that. What we'll do, take a look at the market. We'll review our practice portfolio. And as I mentioned last week, we'll get more in detail on creating dividend searches, utilizing some of the criteria that are taught in the income course, and with time permitting, review and possibly put in additional practice trades as we build up our practice portfolio there. And howdy you there as well, Walter and Stephen and Alfred. Thanks for being here. All right, let's bring up the charts first. And well, just kind of an overview of the broad market indices. Although I believe coming a little off the lows there, the S&P was off about 2.25%, Dow Jones almost 2%, and the NASDAQ 100 off close to about 3% there. Now, relative to our positions in our practice account, you can see the impact on our various positions here, with Altria Group getting it the worst, being off about just shy of about 3%. On average, a lot of positions were looks like they were off a little bit below 2%. And actually, with one of our practice positions, SCG on the utility side, being up about 1.33%. So we'll take a closer look at our positions in a moment. But let's take a closer look on some of the charts here. I'll bring up the S&P 500 here. Bear with me for a moment. All right, here's a daily chart on the S&P 500, and certainly I can see things have not gotten better with the market overall since going back to, again, from the highs on 129, which was pretty much right around that time when we started putting together this practice account. Notice prices did come off the lows, have not gone below the lows from February 9th. However, a bit of a breach of the lows from last week. In fact, attempted to get right around that low range from last week. One area that some technicians may be looking at is the 200-day moving average. Now, on this chart, I actually have a 55-period moving average in green right there, an exponential average. If I want, I can right-click on this indicator here for our purposes and edit that study. Let's go ahead and change it to a 200 period. And we'll go ahead and we'll apply that. And you notice how there's been a violation of that average there. Now, certainly the more that price action stays below that average, certainly may continue building into a case for some of the bears. Looking again from the highs from the market to where we are there, being off about 10%, being off 10% or more, coming off of those highs, certainly puts it more in what's commonly referred to as correction territory. Doesn't mean that's a bear market by any means. As we go ahead and look at the longer term trend, certainly you can see when you see the forest for the trees, even though not a pretty sight recently relative to where the market's been, certainly significantly higher. Now, what some technicians may look for is when prices do break below some of these major moving averages, may start changing their posture. However, investors that are more of a buy and hold are looking at things from a much more longer term perspective. And we'll see where some of the pressure is in the coming days and weeks. But certainly weakness as we've started off the week. And for the bullish case is to see if prices are able to stay at or above the 200-day moving average from a technical observation there. Looking at the Dow, DJX, the average broke down. Again, fight to get back above it, and the close today is still above the low from last week there. And then looking at the NASDAQ, NDX, which certainly has pulled back quite strongly from the highs in March to the tune of certainly greater than 10%. It is still technically above this 200-day exponential moving average. Just shows you as an example how NASDAQ stocks are a bit more volatile. Relative to this class, a lot of the stocks are more than likely in the Dow and the S&P. Seeing is that a lot of stocks that are in the NASDAQ are more geared towards growth and typically may not pay very much of a dividend, although there are some stocks in there that do. So that's kind of an overview of the market right there. Seeing is that from this class is typically looking at things from more of a longer term. If we were to switch this chart and look at it from a weekly perspective, and I'll show you a technical technique that some technicians may apply. Yeah, let's see if I have this set up in here. I'm going to go here. So I'm going to go to Studies and Edit Studies. I have two simple moving averages on here for an example. Now, if you wanted to add moving averages yourself, you can simply go over to the left here and start typing in moving average. And there's what's referred to as a simple moving average, which simply averages all the closing prices for a particular period. Whereas an exponential is a bit more weighted to the recent price action. Some technicians may look for that sensitivity. However, being more sensitive doesn't necessarily mean better, or faster doesn't necessarily mean more accurate. What I'm going to do here is put an example of we'll do a 10 period average, and we'll modify this 120 and put a 40. Now, the application of this is on a weekly chart. So notice it says W up here, and we see in red that's a 10-week, and here on the blue is a 40-week. Now notice very similar in characteristics to a 200-day moving average, which was on the daily charts. If you figure that out, 40 weeks times 5, that would be 200. So basically 5 days in a week, right? Same thing with a 10-week average. If you go and multiply that by 5 days in a week, that would be 50. So kind of the equivalent of a 50-day and a 200-day moving average, which some technicians may look on a daily chart. A lot of talk as far as technicians, the term death cross or golden cross is when prices break down and averages cross. If we look at it from a longer term perspective, going back and looking the crash in 2008, 2000, going into 2009, I'll have to go back probably even further here. So this example I'm going over with you is just an example of how some technicians may use indicators for sentiment, as far as changing their view on the market. A lot of investors and traders are used to a bull market that we've seen for quite some time. But if we go back here and look at this observation of negative crossovers, from the tech bubble, when in this case the 10-week crosses below the 40-week and more of that bear market, and the crossover on the positive side didn't occur until going into the spring of 2003. Going fast forward to 2007, 2008. Started seeing some negative crossovers in beginning of 2008. Market rallied up going into the spring. A little of a positive crossover, however brief there, and market had crashed from there. It wasn't until the spring going into the summer of 2009 where the market had recovered since then. Okay. Now, notice with crossovers, they're not perfect. Okay. It's just one other indicator as of many. You can see times where you've had a negative crossover, and then about a month or so later, another positive one. When prices go sideways, there's a tendency of what are called whipsaws, and that's where technicians will have to attempt to observe different patterns, and when they see that there's a resistance point, they may wait for that resistance to break out for confirmation. So kind of fast forward to where we are right now. This is something that some technicians may be observing in the coming weeks as we go into the spring and see if the market whether holds or continues to sell off. Okay. Notice the 10-week is still well above this 40-week here, but something that some technicians may incorporate as a weekly posture to see on where prices are at. Okay. So hopefully you find that useful, and certainly some to consider as, again, have we seen on such a strong run in the market overall going back to 2009, with a few hiccups in there, particularly in 2015 going into 2016 prior to the election. And so from a best worst case scenario, some technicians may assume that we may just see some volatility similar to what we've seen in previous years and look for the market to break higher. However, if prices go more negative and cross below, that may change some of their perceptions. Okay? If anyone has any questions on that, please let me know. Appreciate you. So as we go ahead and take a look with our portfolio here, and we reviewed this last week as well. The more recent positions that we added was, go back here and bring up our trades on the account set up here. We added a position on LYB, which is a chemical company in the materials area. We position sized basically a half of the position. As you recall, when we discussed risks and money management in our last session, based off the size of this practice portfolio, the position size was typically usually no more than 5% of the overall portfolio. Now, considering on how the market had been pretty much doing a lot of similar things it's been doing today, the thinking was if an investor was not as bullish, wanted to scale in to a position, that's what we used as an example. So in both LYB and also on General Motors, these positions represented closer to about 2.5% of the portfolio. And if we go ahead and add that all up, we actually have that on our TD Ameritrade website. Another great tool that we've gone over each and every week is the income estimator. If you go ahead and bring up any symbol and select income estimator right here, that'll go ahead and bring up a page like this. Now, I already pre-filled this. If you do have income producing stocks in your portfolio, typically you should be able to bring up that portfolio and see what those positions look like. Or you can bring up a watch list of stocks and plug in the number of shares that you're evaluating. And again, that's what's called an income estimator. What it's doing is it's taking the number of shares that are inputted and calculating what the estimated yearly income would be on those positions. And so what I did was, again, I have a watch list which represents the stocks that are in our practice portfolio. Went ahead and put in the number of shares that we have for each of these positions. And again, you can kind of notice based off the number of shares of some of the earlier positions that we did, which was kind of more of a full allocation, that as the market had been pulling back, we were taking relatively smaller positions and looking more of a wait and see if the market would turn back up and possibly break higher. And to this date, we haven't seen that yet. But we've also learned things about this portfolio where, with all these positions added in there, the current market value of these positions is about just shy of about $60,000. Now, what the income estimator does is it takes those dividends calculated over the next year, you know, 4 times for quarterly, semi-annual, twice a year, and comes up with that dividend yield. Now, dividend yield is based off of the market value of these positions. Now, we talked about this last week. Remember, dividend yield does not necessarily translate into the yield that that portfolio is providing for us in this example. Another term would be yield to cost, meaning the total dividends right here, which is at $2,865, or we'll just round it out to $2,866. Those are the estimated dividends. Now, this can change if a company lowers dividends or if they even raise their dividends. This would be recalculated. Now, to come with the yield on cost, we have to determine what our costs were for all these shares, because as we go ahead and look at our practice portfolio here, you can see that our P&L open is negative $4,800, which that's a pretty good hit since the inception here. So calculated that the costs for the shares in our practice account were to the tune of $64,647. So if we basically go ahead and take, bring that back up, the estimated income of $2,800, and we'll just say $66. We'll go to our calculator over here. Take 2866 divided by the cost of the shares, 64,647. That'd be 4.43%. So the yield on cost for this practice account is 4.43, which, as you can see, is lower. Try and bring that up. Which is lower than the dividend yield. Okay, and which certainly is common sense. The shares are less than where they were before, therefore the yield will increase. Okay. Now, Mark says, how do we determine the ability of a company to be able to pay dividends in the future? Well, there is no one sure way of doing that, Mark, but there are certainly some markers that some investors may look at, and actually that will actually move into our discussion when we go through a scan and look at some of the criteria per the course, are some markers that one may search for to imply the ability of a company to pay earnings going forward. But there's certainly no guarantees of that. Okay, but hold on to that, and we'll hit that as we go through our criteria. All right. So I just wanted to kind of highlight that with our account and where we stand. Considering that the account's down about 4,800, if we go ahead and take that 4,800 and divide it by the cost of the shares, which was 64,647, the account's off about 7.4% since January 30th. However, if we go in and look at the chart and compare it against a benchmark, such as SPX, and I'll go ahead and draw from essentially January 30th at the opening, because that's when the first position was opened. The market's off about close to 9%. So, not that that's not necessarily a reassurance there, showing that market corrects, stocks are going to go down. However, relative to the S&P, this portfolio did not go down as much. And the other thing to consider is this is also a relatively higher yielding example of a portfolio that we figure yield on cost about 4.4%. Again, no guarantee that all those dividends are going to be paid out over the next year if anyone was to cut them, but to show you an example of a little bit different in volatility there. Okay. Also compared to an example of someone maybe a lot more growth oriented, going from January 30th to on the NASDAQ 100. Interestingly, technology stocks have been doing relatively well, and that market is off again about 7.8%. Okay, so just showing you some comparisons there between what's on our practice portfolio and what the market has been doing. All right, now let's go ahead and talk a bit about scans. Now, as a starting point, we can go to our coursework. Let's go and bring that up. Through the Education tab, and we want to go to the Income course, so we can go ahead and go to Overview. And select Income Investing and Continue Course. Now remember, we do have the sample investing plan over here under Resources. So we'll go ahead and we'll launch that. And let me go ahead and resize this just a little bit. There we go. Make this a little bit bigger. And if we scroll through on this plan, and actually I clicked on the wrong course there. Had a little slip of the mouse there, my apologies. Hopefully you can I'll talk with our technology partners and see if we can just actually click on Income Investing and go right to the course. So Income Investing, slide over here to Continue Course. And we'll select that Sample Investing Plan. Now as we scroll down on this, get through those disclosures there. We have the Dividend Stock and Stock Fund Sample Investing Plan. The watch list criteria here are discussing on some criteria that some investors may consider on finding some dividend paying candidates. Now, to learn a little more detail on some of these, you can go back into the course and it'll break down some of these criteria a little bit more. For instance, if we go ahead and select dividend stock analysis, it does give an overview of the plan and things that one may consider, such as reviewing dividend history, clicking on that. One of the things is comparing the dividend yield compared to a broader market in the case of the benchmark, such as the S&P. We've been utilizing a filter of about 3% as an example, which is greater than the yield on the S&P, which, well, probably now it may be pushing a little above 2% at the moment. So looking for stocks that are quality or expected to be quality and have a greater yield. Comparison to not only the benchmark, but on what it may have done in the past. And that's where we're looking at a current dividend that is greater than its 5-year average. Now, a stock dividend that's greater than its 5-year average could be happening for one of two reasons. It could be higher because they've been raising dividends, or it could be higher as maybe in the case recently where stocks have sold off, thereby pushing yields higher. Either way, that may point towards some value or growth. If dividends are rising, that's growth. If dividend yields are higher relative to where they've been in the past technically, that may point towards some value. So again, this will go through more of the details as you go through the course, but let's go and focus on the plan based off the time that we have together here. And let's try that one more time. So discussed about dividend yield greater than the benchmark. Dividend yield higher than its 5-year average. And get into your question there, Mark, as far as being able to pay dividends. A dividend payout ratio is a calculation on, as a percentage, how much of the dividends are being paid out. And we have an example here of 70%, meaning up to about 70% of the earnings are being paid out as dividends. Now, if this ratio is a lot higher, then the company may be getting to a point where they don't have too much wiggle room to raise or continue paying a dividend if they are getting to the threshold, a higher threshold of their earnings. Now, a caveat to that, though, is if you go ahead and learn about REITs, REITs by law in a lot of these cases are paying upwards of 90% of their earnings. So that's kind of more of the one-offs, but for regular companies, this is an example of a threshold. And certainly if the number is lower, it gives more room that the company could raise dividends and hopefully continue paying them. Now again, this is not a give me. Things can happen, and can happen very quickly, where a company may have a change of fortune and may have to cut their dividend. And Mark says, someone mentioned to look at a payout ratio of less than 50% as margin to company faced with lower earnings can continue paying dividends. Yeah, so that's another guideline there. You can determine what works for you. Certainly, we're providing one example of 70%. So 70% or less as an example. Now, other things that certainly not explicit, but implied, that certainly if a company has a greater return on equity, signals that the company is effective in managing the funds. And if they're effective in managing the company, that may translate in the ability of the company to continue paying dividends. Other things that can also impact the ability of the company to consistently raise dividends and pay out those dividends is debt. And as you can see here, an example of debt, long-term debt to capital being below 100% indicates the company has more capital than debt. If the ratio is above 100, that means that the company has more debt than capital. Now, just because a company has more debt than capital doesn't translate that the company is not going to be able to pay dividends. It just means that it may be harder over time if debt continues to increase, whereas the capital is not available. Okay. And other criteria, more from the value standpoint, is price to earnings ratio, as an example, that if the company's price relative to their earnings is relatively low, that may indicate that the stock is more fairly valued. Also, if the stock is relatively lower than where it may have been in the past too, typically the yield will be higher as well. Okay, so all these are different criteria that we can go ahead and put into a scan or some type of search. Okay, now if we were to go ahead and practice with that on, let's say, the Thinkorswim platform, we'll go in and we'll do that. So let me go ahead and I'm going to see if I can resize this a little bit here so we can have some of our criteria on there. Make sure I'm not going too far off the screen here. And we'll come up here to scan. Have to size this a little bit more. So come up here to scan. And I already have a lot of criteria pre-programmed, but what I'm going to do is, as an example, we'll just go ahead and act like we're starting from scratch. And show you how relatively easy it is to go ahead and do this. So first, dividend. We can start by, a lot of these criteria are going to fall under add filter for a stock or under add fundamental filter. So I'm going to start off on add filter for a stock. We'll click on that. And notice it adds one right here. The description is stock, so that's a stock filter. And it may bring up just a default criteria here. In this example, we have ask. So what we're going to do here is click on this drop down and look for yield. And so there's yield right there. We'll click on it. And I know I have this truncated a little bit, but when you have a criteria, you have an example of a minimum as well as a maximum. And as a minimum, you can decide on what yield you wish to look for. For our illustrative purposes, we'll do a minimum of 3%. Some investors too may put in a maximum. Usually if you have stocks that have very high dividend yields, particularly in the double digits, they may fall more under limited partnerships and other things, which not saying there's anything wrong with those, but requires more due diligence and possibly some reviewing as far as tax consequences, things like that. So someone may put a maximum on there if they want. Okay, we'll just leave the minimum of 3 for ours. Okay, as we look at the criteria, stock with a current dividend yield that's higher than its 5-year average. Now, there is not a search for that. However, what one can do is on a quote page, they can actually display the current dividend as well as a 5-year average and make comparisons there, which we've done, and I'll show you that. Increase in free cash flow per share can indicate increase in cash on hand, which potentially can translate an increase in dividends. What we'll do is we'll click on add fundamental filter and look for, there it is, cash flow per share. We'll select that. And again, no magic numbers here. Looking for at least some positive cash flow. I'll just put an example of 10 cents. And you can make these your own. You can adjust these numbers however way you want. Now notice when I do this, it actually shows the number of stocks that meet that criteria. And what it's going to do is going to find stocks that meet all these criteria combined. Now, one filter that didn't add, that are very simple filters that will typically narrow down a search, is having a price filter, determining what's the minimum price for the stock. We'll put a filter at $10. And if I go and click scan on this, it'll actually give a list of results. So currently at this point we have about 495 stocks. Okay, a lot of stocks there. Now if I keep going through here, dividend payout ratio between a certain level. Well, let's go ahead and add another fundamental filter, and we'll find dividend payout there. We'll leave over year annual, and we will put a maximum of 70. Return on equity, that's kind of, again, that management effectiveness there. We'll go ahead and add that. As you can see, pretty simple to do and duplicate there. Return on equity right there. And again, you can play around with this number. They say 18. We've put as low as 10. Double digits there. Now notice as we go through and add these and rerun through the scan, that universe of stocks is getting smaller and smaller. Okay. Current ratio means that a company has at least $1 of assets for every dollar of debt. Indicates the company is likely to meet its financial obligations. Now, this is one criteria we've struggled a little bit on this search as far as with some of the results here. So we can bring up the current there. And we'll put a minimum of 1. And notice again, that list of stocks is getting smaller and smaller. Okay. Long-term debt to capital ratio being below 100%. We'll add that filter. Long-term debt to capital. Put a max of 100. And there you go. Notice the list gets smaller and smaller. Finally, we'll put a PE ratio. And that doesn't mean that these are the only criteria that you can use. We'll select the PE from the stock filter. And the reason why I do this is for the stock filter, the yield and the PE are the same values that appear on your quote page, or at least should appear on your quote page. And here we'll put in the value just according to the plan, 5 to 25, and hit scan, and there's 39 results. Okay. Now, one thing that some investors may do is certainly play around with these numbers if you want to have more results. Let's say on the PE ratio, say 28. That may increase the results. Or return on equity. Said 18%. What if we said 15%? Okay. So as you go ahead and expand the criteria, that may give you more results. If you tighten it up, it'll give you less. Other things that you can do is, if you notice up at the top here, it says scan in all optionable. That certainly translates into liquidity. Okay. Another thing, we put in one for price. You can put in one for volume. Now, if you're on your real-time account, you can do a study filter and add an average volume indicator. I'm on to paper money, which we don't have that feature, but I'm going to add another criteria for the stock. and we'll select volume. And if I put in a minimum of, let's say, 750,000, notice between the price and the volume filter, those results got even smaller. Okay. Other filters, as far as what you look in, all optionable. If you want to focus more on larger cap stocks, you can intersect that with, let's say, a public list for the S&P 500. Want to see any stocks in the S&P 500 that may meet some of these criteria. Go ahead and scan that. And here's what we have on this list. Okay, some companies that you may recognize there, some maybe not. So for an example, we have there's Macy's there, there's AbbVie, I think I'm pronouncing that right, more in the pharmaceutical area there, 4.2% yield. Now, if you wanted to, you can go ahead and add stocks into a watch list. You can right-click on them and add it to a watch list. Or you can come over here to the far right and save the entire results as a watch list. So we're going to click on that. And click Save. So that'll be saved onto the watch list. The scan that we just did as an example, if this is something that you want to save and run on a recurring basis, it'll also be part of your lists. You can come up here next to the flame and click on that Show Scan Query, select Save Scan Query, and go ahead and name it whatever you'd like, and click Save. So now, when you go ahead and bring up a watch list and decide to change that watch list on your personal, notice the little bullseye indicators. Those are scans that have been created and saved. And so, we had just created this one as an example. So at any time, if we select that, that will scan for any stocks that meet that criteria. And they would be updated continuously. You can also create and customize these different pages if you want to go ahead and view additional information on the stock. And we did this in a previous session. I'll bring this up as a matter of time here. If you go through and look at some of these, some criteria such as cash flow, there's current ratio, there's a dividend payout ratio. Here's the current yield, and here's the 5-year average. So if you want to go ahead and modify these, you just simply right-click on the column header, anywhere on a column header, and select Customize. And you would go ahead and you can start typing in whatever criteria you want. And so as an example, the yield is one here. One, you can go ahead and just add yield for the current yield, because that's what yield will give you. And that's what we have right here in this column. But if you add dividend yield, this is where you can actually customize this field. So if you go ahead and double click on it or click to add it, it'll move it over here. However, when you slide over a little bit on the dividend yield, there's a little drop down, and you can make that current or 5-year average. So that's why we selected 5-year average. And so even though you can't search for it, this is where you can make comparisons. So for instance, we were looking at, let me go ahead and rerun the one we just did. So we were looking at ABBV in the healthcare area. its yield is 4.2%. Its 5-year average is 3%. So comparing that metric, the stock is yielding more than its 5-year average. Now, its payout ratio, and this is kind of interesting because our scan, and it's not perfect, is actually showing a higher percentage, above 70%. Okay? Some investors may be concerned about such a high payout because if the pressure is to continue raising that dividend or try and pay that dividend, but if their earnings drop off, they may be forced to cut that. Okay, not saying that that would happen, but there's certainly anything can happen. Okay, if we go and look at the chart, just like many other stocks, have sold off considerably. However, an investor may be looking at it from a standpoint from a longer term. Is there more upside to a downside? And certainly no one can tell exactly what the future is, but certainly if prices pull back to lower levels, higher yields, possibly valuations are more attractive, and if prices rise, that would be the benefit. With the risk, obviously, as we've seen on our practice account, prices fall, we can see what the impact is. Okay? So if that answers some of your questions there, Mark, as far as some of the markers that one may look at to help guide on the ability of paying the dividend. Again, no guarantees there. Alfred, as far as the scan, essentially this scan would be updated in real time. There may be a little bit of a lag on it, but since it's linked, it should continually look for stocks that meet that criteria. If you want to manually run it, you can go right to the Scan tab and run it once again. Robert says, John, can you show us how to create an alert when the yield becomes greater than the 5-year average? Ooh, that would be a good one. I may actually have to do a little research on that one, and may not have enough time to run through that. Certainly, if you right-click on the stock, you can create an alert. Okay, and you can create alerts based off of price. You can go ahead and look at other types of things, and I believe in this case it would be more of a study filter. But since we're on paper money, actually may allow us to do it here. Yeah, it may require a little work. I'll set that up as a little bit of homework for our next session, Robert, if you don't mind. Usually you can set an alert for just about anything. It just may not be a turnkey one, for instance, setting an alert on price there. But let me see if I can go ahead and find that condition, and I will get back to you on that. In fact, I'm writing a note on that. That'll be my challenge for the week. Because price alerts are a great way of, when you forget to look at something, be alerted to what's going on, whether it's based off of price or based off of a particular situation there. All right, let's see what else we have going on here. Let's see. Was looking at potentially entering a practice one on ABBV, considering from our example of diversification. Although keep in mind, as we went over our disclosures, that diversification certainly does not prevent you from taking losses, as we can see with our practice account. But as we look at the positions, our examples here, representative from usual suspects of sectors that have a tendency of paying relatively decent dividends: consumer staples, some discretionary, in this case, the home builders, utilities, materials, energy. We have some representation there, not necessarily a representation from the healthcare area there. Okay. Now there are other examples here, like for instance, here's Cardinal Healthcare, which is another one that not as a higher yield, but certainly greater than the market and greater than its 5-year average. And looking at the dividend payout, relatively in the lower range, so meaning more wiggle room for that as well. Okay, and we can look at the chart on that one as well. And certainly generally the trend has been a bit more down, has corrected much like other stocks, still well above some of the lows from back in the fall there. Looking more recently here. So, as you can see, certainly price has been a lot of headwinds with a lot of these stocks. We've been doing a lot of this stuff for illustration purposes and also seeing just what the impact of the market is on the account. And we've learned a few things. That the account certainly has taken a hit relative to the market, not necessarily as bad compared to the potential dividends that are being paid out. Okay. Yeah, Robert, I know probably you can definitely do it on ThinkScript. I'm trying to see if there's a turnkey way as far as on the yields. Let's see. Anything else? Of quite a few of these stocks, on the S&P 500, certainly have been showing higher yields. Now, there's not saying that it has to be a large cap stock, although some investors may gravitate to that. If we go back to that scan and look at clear that filter and look at the whole market there, you may see some other stocks that may pop up. All right. Now we are getting to the top of the hour, so what we'll do is let me go ahead and bring up our list one more time. I also went ahead and just make an adjustment on return on equity, kept in the double digit, and seeing if any other stocks pop up on the list here. The other area we're looking at, for an example, was in the transport area. UPS has a 3.5% yield, and relative to its 5-year, I'm going to have to go ahead and modify this search here. Let's go ahead and save that, for example. And we'll go ahead and sort this here. So UPS 3.5% compared to its 5-year of 2.65. The payout ratio is 56%. Okay, so just looking at these as an example, PE ratio of 19. Again, looking at the chart, you can see the example of certainly why yield is much higher. The stock's lost about 22% since February. And there can certainly still be some more downside pressure. Markets at longer term support. If the support holds, there may be some upside. If the market continues selling off, that can certainly carry a lot of stocks further down. So what we'll do is we will take an example for UPS for a practice account, and again continue to diversify that. Now with UPS, currently at $103, we're doing a 2.5% as an example, basically half of a position. And so based off of that, 100 shares, maybe closer to about 150, for example. Let's see if we'll be able to do that. because basically 3,500 would be approximately 2.5% there. So let's try 150 since we're getting close to the top of the hour there. That'll work for us. And that was the wrong stock. It's supposed to be UPS. I don't know why that did not work. There we go. We'll go ahead and we'll send that through. For instructional purposes, we'll put it in a market order just so it gets filled for the morning. And there we go, folks. Hey, it is the top of the hour. I always try and end up on time, but it does not seem to work. Remember, folks, everything we discussed here today was for educational and illustrative purposes. Let's go and bring up our slides there once again. The symbols that we went through were meant to illustrate the platform as well as simulate and practice the paper money platform for position sizing and building up our practice portfolio. So I appreciate your time here this evening, folks. We'll catch up with you next week. We'll do a scan on the TD Ameritrade website, and we'll go ahead and take a look at our portfolio and see where we're at. So thank you so much, folks. Have a wonderful day, and we'll talk to you again real soon. Bye now.